Hey guys, how's it going? And thanks for coming. I'm Nick, and this is Real Life Money, where we talk about real life and money, because you know schools aren't, so let's get started. Alright guys, so for this video, I'm actually excited for two reasons. First reason is I learned how to put pictures in videos. Like, bam, there's one there, and here's another one, bah! I don't know what those pictures were. I'll probably have some random pictures later on. But for the second reason why I'm excited for this is that I actually get to show you what I'm talking about. So that's why in this video we're going over mutual funds for beginners. I'll actually be going into, and you'll be looking at mutual funds with me, and I'll be just going over the basics of what the hell to look at. Now, showing you guys this is awesome just because, like, reading things or listening to even, it isn't the same. It's like, oh, watch out for returns, expense ratios, asset classes. You're like, okay, really don't know what those are, but I'll give it a whirl. So then you go into these mutual funds like, what are all these numbers? Alright, so before we get started, I do have another video going over the difference of stocks versus mutual funds. If you're interested in that, I'll leave a link in the description so you could check it out. A quick overview of what a mutual fund actually is. So there are stocks out there, right? Just companies. Apple, Google, Disney, McDonald's, whatever. Mutual funds are essentially packages of a bunch of stocks. So one mutual fund could have Apple, Disney, McDonald's all inside it. That's essentially it. Of course, I'll go into more detail with that other video I talked about a second ago. But there are pros and cons to that. But today we'll be focusing on mutual funds. So for these mutual funds, there's a bunch of different brokers out there. What a broker is basically where you could buy these mutual funds. There's Vanguard, very, very popular one because their expense ratios, we'll be looking at them in a little bit. Their expense ratios are so low. They're like dirt low. They have Fidelity. I use Fidelity as well. And then other brokerages could be like E-Trade, Scottrade, Ameritrade, bunch of those platforms as well. I mean, those, if you want to trade mutual fund, not trade, but buy mutual funds on your own, you could also go to like a bank, like a JP Morgan Chase. You could buy mutual funds from them as well. So real quick before we get into it, what I'm going to be showing you, these funds are actually from Vanguard. You could simply go to their website, just look under or browse like mutual funds. Took me a little bit, but you gotta look around. But once you pull that up, you could see the list of these funds that we'll be looking at. Alright, so those are kind of all the things that I needed to get out of the way. So let's start looking at some mutual funds. You will miss my pretty face, but it'll be back later. Don't worry. Alright, so let's throw some mutual funds up at there. Bang! Alright, so now we're looking at some mutual funds, guys. So let's start from the top. Along the top shows you all of the categories that we're going to look at. The name, ticker symbol, asset class, all that stuff. So, what goes up and down? Columns go up and down? Alright, so the first column is the name. So you can see these are money market mutual funds. Money markets, similar to, you know, you have a bank account, you could have a checking account, savings account. There are other things called money markets. Money market is very similar to both the checking and savings. They pay interest. And like I said before, what a mutual fund is, it's basically a package of a bunch of things. So these mutual funds are a package of money markets, different money market accounts. So that's what we're looking at. I'll be going into bonds, you can see a little bit further down, and also stocks I'll be looking at, which my personal favorite. But first, you see the name. First one is Federal Money Market. Then we got Prime Money Market. Then California Municipal, sound it out, Money Market. Those are the names. That's all it is. Nothing too crazy. You probably don't know what that even means, and neither do I. So let's move on. It just tells you the name of the fund. So now let's look at the ticker symbol. What a ticker symbol is, it's basically an abbreviation for the fund. And back to my pretty face. So looking at the ticker symbols, guys. So let's think of stocks right now. Let's look at Apple. Everyone knows Apple, that's why I pick it. Apple's ticker symbol or abbreviation is APPL. So if you want to buy it or sell it or do whatever you want with Apple, you use that ticker symbol. So back to the mutual funds, bang. All right. We have the ticker symbols, and they're basically whatever you could buy, sell them at. If you want to look it up on, let's say, Yahoo Finance, you use that abbreviation to look it up. That's all it is. And then we see the asset class. It's basically telling you what these investments are. So obviously, like we said before, we're in the money market funds, and it tells you the asset class is the money market. So that makes complete sense. So I changed it up a little bit for you. These are bond funds because I wanted to show you the different asset class. Same column, asset class, it tells you these are bonds. Give you a little bit more detail as well. Interterm government, interterm, a little bit lower down is long-term. I'm no professional with bonds. That's just not my thing, but it tells you a small description of what you'll be investing in. Alright, and bang, we're looking at the stock funds, which are more my forte, so we're going to finish it off with this. But, so we went over name, ticker symbol, asset class. So, expense ratio. What is an expense ratio? So you could see these. You got 0.04%, 0.36%, 0.08%. What does that mean? Well, that's essentially what you are paying for the mutual fund. And back to me. So looking at expense ratios. Let's say you have $1,000, right? And if the expense ratio is like 0.02%, you're going to be paying 0.02% of the 1,000, and that's going to be your expenses, which is $2. So like obviously, like what we said before, these Vanguard funds are very, very, very low expense ratios. $2 for every $1,000 is fairly low. That's why people like Vanguard. Back to the table. Alright, so back to the table. We got the expense ratios like we just said. That's what you are paying, and each fund is different because they do different types of things. There are active funds which could be traded very often. They might take one stock out, put one stock in, and move it around. Obviously that's more work, so they're going to be paying more expenses. More passive way is just kind of having a group of stocks and it's just sitting there. That's going to have low expenses. So you could see these variations of expense ratios. So the next column we're looking at is price. So guys, let me relate the price of what we're looking at to actual stocks. So let's look at Apple again, because who doesn't like Apple? Their price right now is around $150. So if you have $150, you could get one share. With these price for the mutual funds, it's essentially the same thing. You need to pay that price, whatever it is per share, to get one share. Now, one of the main differences about stocks and mutual funds is that, to make things easy, let's say you have $200 and you want to buy Apple stock. Like we said, they're at $150. Well, you could only pay $150. You can't buy two because then that would be $300. You don't have $300. You can't have fractional shares in most situations. You can't buy 1.2 shares of Apple. But with mutual funds, let's say you have $1,000. You put the $1,000 into the mutual fund that you choose, and then you get, you might get, let's say, 4.8 shares of that fund. Alright, so going back to the graph, you could see the price. There's $228.51 for the first shares of the 500 index Admiral shares. Admiral shares, yeah. Next price, $33.96 for diversified equity. That just tells you the price per share that you're paying. So moving on to the change. So today's Saturday. I'm recording on a Saturday, so the market is closed. So these numbers are looking at the what the market did on Friday. So for the first fund that we're looking at, the 500 Index Admiral shares, they were down 30 cents, or you could see the next column that also equal to 0.13%. So on Friday, they were down a little bit, and that's what that's saying. You could see a little bit lower. You could see some green arrows, like the dividend appreciation index Admiral shares. I had to think about that before I said it. But 0.05, well, 5 cents it went up, and it went up 0.2%. So that changes for each fund. Alright guys, so we're next going to be looking at yields, or dividend yields. So it is very similar to what you get at a savings account. You know, obviously your savings account, you might get 0.1%, like garbage dirt. But with, like we saw before, with money market or bond funds, those pay interest. So the price might go up and down, like with Apple, it could go up to 160, it might go down to 140. But they have a yield, a dividend, because you are an investor, you're an owner. So they pay you for holding that investment. This is what a dividend or a yield provides. Doing a fade back into the chart over here. I'm liking these effects, kind of. But, so, as you can see, kind of like 2/3 of the way over, SEC yield, like we were saying, this is the yield that you're getting. So you could see 1.97%, 1.3%, 1.93%. No matter what the price does, you get that yield, essentially. It might go up a little bit, down a little bit if price moves, but you know, if the stock drops, let's say 10%, you are still getting, I mean, it might not drop that low, depending on what happens, but no matter what the price does, you're still going to get that yield, that dividend, that interest, whatever you owe. So, so no matter what the price does for that first fund, you're going to be getting 1.97%. Definitely hell of a lot better than a savings account. So that's why I like dividends and stocks. So let's move on to the next thing. So these are returns. So YTD, or year to date. That basically tells you what the stock has done from the beginning of the year until now. Right now we are, when the hell are we? We're end of July right now. So this tells you what it's done from January until the end of July. So you can see the first one is returned 11.64%, guys. You can see the next one 12.9, next one 10.65. Those returns kick the crap out of savings accounts, I can tell you that. So, and the next columns are just pretty self-explanatory. It tells you what it has done for the past year, 17.85 and so on. Then for the 5-year, this is the average annual return in 5 years. So the average return of each year of the 5 years was around 14.5, and then for the 10 years is just over 7%. Alright guys, so I do like to look at these returns. That's actually like the first thing that I look at is the return. How is this fund doing? So you could see how it done year to date. And it's good to know, but it doesn't really tell you much because it's not like that's going to happen again. It's just tell you what it did for the last several months. I don't really judge my, purchase or initial investment on what it has been doing. Same thing with 1 and 3 years. It's good to know, but it's not like that you're going to get that. So the last column that we're actually going to be looking at is my personal favorite, especially if you're looking for the long term, guys. If you're like picking mutual funds for like retirement, or if you're just holding them to grow long-term money, is since inception. So what since inception means is when the fund was actually created. Some could have been created, a few years ago. Some could be older. Let's take a look. Alright, so that last column all the way to the right over there, since inception. So, of course, looking at the top, it says 5.62%, and it was created November 13th, 2000. The next one was created June 10th, 2005. So you could see these returns are much different than their 1 year, 5 year, and a little different than their 10 year as well, because there is more to average in. Since it was created in 2000, there was the tech bubble. Tech stocks were skyrocketing, but then they dropped like no one's business. So that averaged that in. And also in 2008, stock market crash, the Great Recession, that averaged all those bad years in. So it evens it out a little bit, and it is much lower. Now, if you look a little bit lower in the list, like for example, look at the name right now. I'm looking at equity income. It is 1, 2, 3, 4, the fifth one down, equity income, and also growth income. And if you scroll all the way back over to the since inception, those were created in 1988 and 1986. So I personally like going back further because it gives you a more accurate representation of what stocks have done in history. So you could see, in the late 80s, the average yearly return was just over 10%. So a lot of different funds are actually older than that. Some, I know I have one. I think it was created in like in the 60s, like 1966 or 68, 64, something like that. But I like seeing that track record because it has all the peaks, and yeah, you want to, feel good, but you also want to be accurate in what happened during, when crap was going on, like the tech bubble, the Great Recession, other bad things that were going on. So the more accurate representation that you could get from the history, the better, in my opinion. So that's kind of the overall basics of how to look at mutual funds, guys. I thought this was pretty cool to actually go over with you instead of like, oh yeah, if you do it on your own, you could find this, and then you're like, okay, I don't know what the hell you're looking at. But so I'm glad I could do that with you. But it feels like once you understand what the hell you're looking at, it is actually much, much, much easier, and I'm hoping that this actually helped you out. So that's basically it, guys. Other videos I'll be going into more mutual funds, actually going into the mutual funds, looking at mutual funds that I look at, maybe even 1 or 2 that I own, so I could actually show you more detail into it if you're into that type of thing. So if you have any questions, comments, concerns, leave them down below, and don't forget to subscribe to my channel, Real Life Money, where we talk about real life and money, because schools aren't. So thanks for watching again, guys, and I'll see you in the next one.